So one of the biggest challenges to a 1031 exchange is there are timings about when you have to identify and also purchase a property. So at the time of sale, you have 45 days to identify a property that you would want to buy. That could be more than one property. It could be multiple properties, but you do have to identify it and you have to make sure that you document it. Then you have, from the time of sale, 180 days to actually purchase your next property. So if you miss these deadlines, it can then make it that is no longer a viable 1031 exchange and that you would incur the taxes based off the sale of said property.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride.
Welcome to Critical Thinking Required. I'm your host, Tim Bickmore, and today we're going to talk about 1031 exchanges. A lot of our clients have investment real estate, and they're always inquiring about how they can be most tax efficient about this type of an investment. And like anything, 1031 exchanges comes with their pros and they come with their cons. Now, I know sometimes this content can be a little dry, so I'm going to try to, pick it up a little bit, make it a little fun so people can get educated and learn about how they can defer their taxes if they want to. A great place to start is to define what a 1031 exchange is. A 1031 exchange allows investors to defer capital gain taxes when they sell an investment property, as long as they use the proceeds to purchase another like-kind property. In simpler terms, you can sell one property and buy another property that is similar without paying taxes on the profits immediately. So let's talk about some of the benefits of a 1031 exchange first. The most significant benefit is that you can defer any capital gains into the next property. Like I said, if I own, for example, single-family residences that I rent out, and I see another opportunity, but I need the capital in that property in order to buy that next opportunity, or I'm just done with it, right? I can go ahead and sell that single-family residence, and then I can subsequently go and buy the next single-family residence. And instead of creating a capital gain at the time of sale, I can take that gain and I can push it to the next property. Now, there's some mechanisms and there's some nuance to that, but overall, it allows me to defer that capital gain into future years. The second benefit to a 1031 exchange is this idea of compounding power. Think about it. If I were to sell my first property and not pay taxes, that means I have a bigger dollar amount that I can then invest into another property, which means that I have more of a dollar amount, which means I can compound that money at a higher rate. So having more money over time allows me to compound at higher returns, meaning I'm earning more money over time. So we always want to make sure we emphasize that, as you don't want to underestimate the power of compounding. The third benefit to a 1031 exchange is that you can really exchange property into all sorts of different kinds of property. So when the IRS defines like kind, what it really means is that you can invest in something that is for business and or investment, but it does have to be property. So to give you an example, like I mentioned, let's say I own a single family residence and I sell that residence, but then I want to get into a multifamily residential property. That would be considered by the IRS a like-kind exchange or a like-kind property. You could also go into a commercial property. What you can't do, though, is you can't take that property and then take those proceeds and invest in the stock market. That would not be considered a like-kind property or a like-kind exchange. So the benefit here is that you can move around within those properties into multifamily, commercial, single-family residence. And again, there's a few other nuances to this, but that is a really big pro, being able to move your assets into different types of property over time. The last benefit here, based off how the current tax code works, is that if we are able to continue to defer our taxation over time, let's say that we want to then pass these properties down to our heirs. We would then get what's called a step up in cost basis at the time of death. So, for example, I build all these properties, I continue to defer my tax, and then I pass. Then what would happen with my heirs is they would be able to step up the cost basis at the time of death to whatever the value of those properties are at that time. Which means if they went and decided to sell the properties and no longer exchange it into other properties, that capital gain would actually then go to zero. So in essence, being able to be very strategic about our estate planning and using the IRS code, we can actually be not just tax deferred, but it could eliminate the majority of taxation over time. Now, there's a lot of other nuances to that, but it is a really nice benefit when we're looking at how to strategically utilize a 1031 exchange over a long period of time. Now, with any financial tool, there's always cons to it, right? Or nuances that make sometimes these rules a little difficult to follow. So one of the biggest challenges to a 1031 exchange is there are timings about when you have to identify and also purchase a property. So at the time of sale, you have 45 days to identify a property that you would want to buy. That could be more than one property. It could be multiple properties, but you do have to identify it and you have to make sure that you document it. Then you have, from the time of sale, 180 days to actually purchase your next property. So if you miss these deadlines, it can then make it that is no longer a viable 1031 exchange and that you would incur the taxes based off the sale of said property. This is something that's very important to make sure that you understand, because if you do understand it, you can be strategic about when you want to sell and then starting to identify those properties and knowing that you want to purchase them. But those timelines do create constraints and sometimes you can be missed. So we always want to make sure we educate and let our clients know that this is how it works on the back end. The next nuance or con to a 1031 exchange is understanding the additional transaction costs that may come with this. With a 1031 exchange, you really have to pay attention to the additional costs such as transactional fees, legal fees, or broker fees, and closing costs. Also, what you do have to establish is a qualified intermediary to be able to process this transaction. This means that you will not just receive a check for your proceeds, it will actually go into an escrow account where this third-party intermediary is handling it. So you technically never touch these funds. So you sell the property, it goes to the intermediary then purchases the next property in which you're looking to buy. So this sometimes can be difficult. Not everybody's a qualified intermediary. You have to make sure you go and source it, find it, and allow it. They do have them. They are around. You just have to make sure that you identify it. And sometimes these intermediaries do come with an additional cost on top of the typical legal, broker, and or closing cost fees when purchasing a property. The third potential con to a 1031 exchange is if you need access to cash. If you need access to cash, it is going to be very difficult to access it if you want to perform a 1031 exchange. You have to take all of the gains at the sale of the property and roll that to the next property you're going to purchase. In addition, you have to buy a property that is as great as the value of the current property being sold or more. You cannot buy a property for less, meaning that you pocket some of that cash. In essence, they're trying to incentivize you to take all of your proceeds and move it into the next property without receiving any cash on hand. So sometimes this can be difficult. However, there could be a strategy where you perform the 1031 exchange, you do add some debt to the property, and then you're able to access cash that way. However, that is going to come at a cost as you are going to leverage the property in order to access said cash. So if we are thinking about needing access to cash for cash flow purposes, performing a 1031 exchange could be very difficult and something that needs to be really thought of. Like we always talk about with personal finance, we need to understand our goals, we need to understand what we're trying to achieve, and see if this type of a tool is applicable for the situation and goals for the end client. One of the last potential risks is market fluctuations. Real estate, even though you don't see it all the time, can go through ups and downs. Real estate's not quite like the stock market where you see a day-to-day or intraday ticker, prices moving up and down, up and down. But real estate markets do fluctuate in the same way. It's just not as visible. So we have to be paying attention to when we're selling our property. Is it the most opportune time? Is it at its intrinsic value? Is it not? And typically with our own clients here at LBW, we actually help evaluate that. When is the right time to sell? Is this next purchase a better purchase than what we're already turning today? If we want to sell our property, defer our taxes into the next property, we want to make sure that we are leveling up and it is a better investment in which we are already currently in. If not, it may not make sense to sell. It may make sense to sit on our current property and not move those assets around. So to conclude, always the question, is a 1031 exchange right for me or for you? The answer to that is it depends. You first want to make sure that you evaluate where your current property is. Why do we want to sell? What returns are we making on that current property? Are they high enough? Are they achieving what we would like? If so, if we check the boxes as like, you know what, it's not as good of a return, we need to start moving it forward, we want to look at this other purchase of the property, then yes, a 1031 exchange could make sense. If we don't need access to the cash, we want to continue to diversify, we want to continue to defer those capital gains, then yes, we could use a 1031 exchange. However, if we need access to that capital for any reason, it may make sense to take the tax hit today in order to get access to said cash. Again, it always depends on the situation of the household or the client and what the objectives are in order to achieve what they're looking to do. There are multiple tools out in the personal financial space. The goal is to make sure that it's applicable at the time and appropriate for the situation that's at hand. So if you are questioning, should I do a 1031 or not, give us a call. We're always happy to talk about it, evaluate it, and make sure that we're utilizing this strategy in the most appropriate way. Hopefully this wasn't too dry. Hopefully it was fun. And thank you so much for listening, and we'll talk to you soon.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time.